tracking here at 12 noon. You're with us here on Halftime Report. I'm Prashant. And of course, I'm making a guest appearance, Mangal and Sonal. Hi guys. I mean, absolutely flat, right? Not very much happening at all. So this is almost a repeat of what we saw yesterday with the market doing nothing for the most parts. And then in the last hour, we saw a surge. The only thing is, I think at some point we will hit that new high. So everybody's very keenly waiting. And as often happens when you're waiting and expecting it to happen, it takes longer. So I think that's what's going on. 3-point change, that is how flat things are. Mid caps and small caps, I mean, they're also largely unchanged, slightly lower. The last I checked, 1:1 advances to declines ratio. Metals, real estate stocks are lower. PSU banks and IT stocks are higher. I mean, a bit of reversal from the kind of price action we saw yesterday. So no discernible sort of straightforward conclusions you can make off this market, except the fact that we're very, very close to all-time highs, and that should be a matter of time. Guys, hi.
Hey Prashant, hey Mangalam. And there's a sudden quiet, right, as you guys are pointing out, after that barrage of earnings that we got. Yeah. Today, there's actually nothing, not many stocks which are in focus, except for the two listings that we'll discuss, and the markets as well. As Prashant mentioned, we are waiting for those highs or those levels that will be the record high levels for the Nifty. But Mangalam, what are you tracking?
It's interesting, the base for the market, the fulcrum keeps increasing. Earlier, we were talking about 18,100, 18,000 being a strong support. Once we crossed that mark, then it moved all the way up to 18,300, the level that we've been talking about over the last couple of trading sessions. And today, it seems to have moved to 18,400. Question is, are we doing a step-by-step move towards that all-time high where at every 100-point move, we see a bit of a tug of war? That's exactly what's taking place at the 18,400 mark as well. The only two things that stand out today for me, one is that both legs of the Nifty, which is the Nifty Bank and the IT index, are firing. So will that propel the Nifty further? And the second one, in light of all of this, there is notable underperformance from the mid-cap end of things. The mid-cap index is down almost 0.4% today as well, with more stocks declining than the number of stocks which are advancing. Currently, as we speak, it is at the low point of trade. So these are a bunch of things that we'll be watching out for. And will there be another last hour surge today as well or not is something that we'll know. But what's not doing well is Metropolis, because sources tell CNBC-TV18 that the IT department is conducting searches at Metropolis Health. Timsy spoke to us about this, but Timsy, there's fresh news. Chances are that maybe the top management is under the scanner too?
Yes, well, as you already said, the Income Tax Department is currently conducting search operations at various locations of Metropolis Path Labs covering Delhi, Mumbai and Chennai. The allegations that the IT department is claiming against Metropolis is that they have a huge quantum of concealed and unaccounted income, for which these search operations are underway. The top
Right.
And when it comes to what exactly led to this investigation, well, IT department sources say that the investigation has been ongoing, and as soon as they got the confirmed lead, that is which has led to these search operations. However, as we speak, these search operations are underway, investigations are underway, so we cannot conclude as to what actually led to these search operations, but yes, as of now, sources claiming enough evidence available of unaccounted and concealed income, which led to these search operations.
All right. Timsy, thank you so much for joining us with all those details. Metropolis held down 5% in trade today. We'll keep coming back to you for more details on this one. But let's move on. GE Shipping, that is the first corporate on our show today. Company posted a strong set of Q2 earnings with a stellar jump in revenue and profit. They have also announced a second dividend in FY23. To discuss this and more, we are now joined by G. Shivakumar, who is the Executive Director and CEO at the company. Mr. Shivakumar, good afternoon. Thanks a lot for joining us. Well, it's been a very strong performance for you this time around. Q2 has seen best ever quarterly profit turn net debt negative, basically, or net cash now for the first time ever. Can you give us a sense of how pricing is right now in terms of freight rates? Because most of the players that we speak to have been talking about how freight rates have been coming down. Can you give us a sense of what they are right now? And how much does dry bulk account for in your overall revenues?
Good afternoon, Sonal. Thank you for having me. Let's look at freight rates across different types of ships. Tankers, which constitute about 60% of our fleet, are doing very well indeed. Especially crude tankers have gone from strength to strength in the last couple of months. They had a good quarter. July, September, they had a good quarter. And this quarter's, they've got even stronger. That's for the crude tankers. Product tankers were very strong in the last quarter. The strength has come off a little bit from them, but still at very profitable levels. Dry bulk is the sector which is actually seeing some weakness for us. We had a pretty good quarter in Q1 FY23. Q2 was a little worse. After Q2, it's come lower also. Across the board, still at or above break-even for the overall fleet for dry bulk, but significantly down from the previous year and from Q1 of this year, which was a very strong dry bulk market.
Right. If you could give us a sense of what proportion of your revenue comes in from the dry bulk. You said 60% comes in from tankers. In that, how much of that is crude? How much of that is product? And on dry bulk, you said they're significantly high. I remember back in the day, you would talk of levels of almost 80,000 for dry bulk that had crashed all the way down to 3,000. Where do they stand at now?
So the Cape-size bulk carriers, the big ones, are earning about $11,000 to $13,000 a day in the spot market. The smaller bulk carriers are earning anywhere between, and depending on where they are, it could be anywhere between $10,000 and $18,000 a day, depending on where they are. And some of the voyages are a little lower in pricing, depending on the positioning. Coming to share of revenue, I won't look at it in share of revenue because that changes on a day-to-day basis. Instead, let's look at share of number of ships. We have 43 ships, of which 14 are bulk carriers. So a little over 30% of our fleet is bulk carriers. 7 of our ships are crude tankers, and 18, so that's more than 40% of our fleet is product tankers. And the remaining 4 ships are LPG ships, which are on time charter, so they don't really get affected by the spot market. That spot market is very strong as well.
Right. Mr. Shivkumar, but isn't looking as a percentage of revenues perhaps the better way? Because counting by the number of ships, I mean, there's a big difference, right? Crude tankers is 20% of your revenue, around under 20% of your revenues, right? Product is about around 40%.
No. So based on the strength of what is happening now, so for instance, let me just give you an example. Crude tankers are earning in excess of $50,000 a day currently, while bulk carriers are earning on average $15,000 a day. I'm just giving you as an example. So those 14 bulk carriers are actually earning less than about half of what the 7 crude tankers are earning.
Okay.
But get that 14 into 15 versus 7 into 15.
No,
yeah, so that's why the revenue mix changes a lot from day to day.
No, so are you, okay. No, it changes, but it's been, do you see any dramatic differences or this is largely the way?
These are big differences. So you'll see the crude tanker, sorry to interrupt, you see the crude tanker average for the last quarter was $35,000 a day.
Okay.
Currently, ships are earning $50,000 a day. So that's sort of where it's different. Dry bulk were in the 20s, currently earning probably in the teens. So product tankers have come off a bit, so probably down below $30,000 a day on average.
You know, one thing we were seeing is that, sorry, got that point, sir. That spot rates were coming off sharply, whereas charter rates, I mean, obviously they'll work with a lag. So are you, will that eventually show up in a big way? Weakness?
Yes, spot rates have come off sharply in dry bulk. I take it you're referring to dry bulk, and charter rates have come off as well. And our ships are mainly in the spot market. So dry bulk, our entire fleet is basically running spot or very short periods. So there the pricing is coming down. Crude carriers, product carriers, pricing has gone up, as I mentioned. So those are improving. So crude carriers are improving. Product tankers are coming off a little bit.
Okay.
And is reflecting in, over a period of time, this will also reflect in the time charter rates.
All right. So that is about the freight rates. In terms of your fleet addition plans, what do you have in place? You did talk about selling few ships in Q2, which led to more cash in your books. But by the end of FY23, FY24, what would that look like?
So again, That's a forecast of the market. We don't know what it will look like. We're already net cash. We're already net cash $30 million as of $25 million as of end September. And it's just added on since then because the cash flows have continued to be strong. We would like to do CapEx. We have a requirement to do CapEx because we would like to grow. However, prices are quite a bit above our comfort levels. You can see it in our net asset value, which has grown by 30% within the last 6 months, which includes fleet value growth plus the cash flows from the business. We were at about 620 rupees in March. We are now at 810 rupees. So that's a big growth in net asset value, 50-50. That's between asset price improvement and cash profits for the 6-month period. So prices have gone up quite a bit. And again, I've mentioned in the past, we are value buyers. We like to be disciplined on this. We know it's a cycle. It'll turn at some point. We don't know when that will be, and we'll wait for that point.
You had also in the past said that, you are looking at buying something perhaps somewhere towards the close of this year near the fourth quarter. But we'll let that be because, these things are variable. If you could give us a sense of the break-even prices for all your verticals. You said that dry bulk at around $11,000 to $12,000 per day is just above break-even. Can you give us the break-even price for all of this so that we know that if we're tracking the prices on a day-to-day basis, we know whether you're breaking even or not for a product, crude and dry bulk?
Yeah. So typically product and dry bulk will be in the region of $11,000 to $12,000 a day, or maybe a little lower than that, maybe $10,000 to $12,000 a day. Crude tankers also, because we bought them quite a while ago, and some of them are written down, etc. Probably also in around the same numbers, maybe 12,000. Gas carriers, because we bought them more recently, that is in the last 5 years, and typically those are more expensive assets, maybe in the mid to high teens. So overall, the fleet break-even would be somewhere in the $11,500 to $12,000 a day region as an overall fleet, and it doesn't vary much between different types of ships, except for gas carriers, which are a little bit of an outlier, being higher cost assets.
And finally, any of your fleet going into dry dock in the next couple of quarters?
We have ships in dry dock all the time. Typically, 1/4 of the fleet on a thumb rule kind of basis, between 1/3 and 1/4 of the fleet every year will go into dry dock, which means about 15 ships in a year. So you'll typically find ships in dry dock. Currently, we have 3 ships in dry dock, all product tankers.
All right. Mr. Shivkumar, I know this does not impact you in any way, but I read a story, I think yesterday, day before, which said that the container market is also going into a huge surplus from absolute shortage. It's now oversupplied. Is that correct? And any implications as you see it?
Not our market, and we read reports same as you. But it's not surprising. The cycle plays out. And it's just that, sometimes the cycle gets very extreme, like it was in containers last year and, up to middle of this year. It's not surprising at all that the cycle corrects itself. There's also a big order book of container ships, which luckily we don't have a significant order book of new ships to come into the world fleet in any of our sectors. So it's a cycle playing out, and that's what we've seen, over the decades.
All right, Mr. Shivakumar, it was a pleasure speaking with you. Thank you so much for joining us, explaining the business and also what's happening in the industry as well. That's the word coming in from G Shipping. With that, we'll slip into a break now. On the other side, we'll connect with Ramani Dati of Team Lease Services to discuss about their Q2 earnings and business outlook. Stay tuned.
Welcome back. You're watching us here on Halftime Report. Even as the mid-cap index is under pressure, a theme that is doing well is the defense theme. Be it land, air, or water. All the stocks are doing extremely well. We have BEL at the high point, HAL at the high point, and Mazagon Dock doing extremely well as well. So that's the defense theme. But one stock which is on our radar right now is Team Lease. That's after their weakish set of second quarter numbers, where the margins in this quarter had seen a bit of a dip year on year. General staffing growth, however, continues to grow extremely strongly. We do have the management with us. Ms. Ramani Dati, who's the CFO of the company, joins in. Thanks a lot, Ms. Dati. We were hearing Ashok Reddy in the conference call, and I quote him. He said that we did enter the year with very optimistic views of a continued tailwind, but there has been a softening in the external environment. Could you give us a sense of what this means in terms of performance for you for the second half on revenues as well as margins? Because for the first half, you're still strong at 32% revenue growth. Can you give us a sense?
Yes, Ashok's comment is specific to IT industry because last 2 years we had phenomenal growth in our IT staffing business. And at the beginning of the year, on the back of our performance over last 2 years, we increased our investments, increased our teams and the bandwidth, everything. However, starting early Q2, we have seen very strong headwinds and the outlook becoming more and more sluggish. So on top of that, we are also seeing a few other segments like the EdTech and a few other emerging segments. There also we have started seeing some sort of slowdown. So that's where his comment is specifically. However, as you rightly mentioned, in the overall general staffing, we are seeing very strong trends, be it banking, financial services, insurance, retail, e-commerce. So in all those segments, including industrial, manufacturing, we are seeing very strong outlook. However, IT is one segment which is having very strong headwinds.
Okay, so what does that in general mean for, say, specialized staffing revenue? The growth there is slowed down. Of course, as you said, it is largely for the IT segment, and you've spoken about other segments as well. In terms of the headcount, specialized staffing revenue, or what is the outlook looking like?
Yeah. So in our specialized staffing, 80% of our headcount is with IT, only 20% is non-IT. So on the IT front, we are not expecting any growth, be it in terms of headcount or revenue for second half of the year. However, the non-IT segment, we are expecting growth as well as margin expansion. So for full year in specialized staffing, we are forecasting almost a flattish revenue compared to last year. However, there will be an improvement in margins because we are moving to more and more higher margin businesses on our specialized staffing mandates.
Ramani, one of the things which analyst is pointing out is that the unallocable expenses are quite high at about 13 or 14 crores. This was high in the previous quarter. You'd given a guidance of that being at about between 6 and 7 crores. It's more than double of that. Could you tell us what is the reason and what's the plan to bring this lower?
Yes. So our unallocated expenses will continue at a trend of 8-9 crores per quarter. So this quarter, what we have done is one of our businesses is on a sunset mode. So we do a small government training business. So since that is on a discontinued mode, so we have moved it from operating segment to unallocated. So that has contributed to almost 4 crore difference on the unallocated EBITDA bucket. Otherwise, that 8-9 crore per quarter kind of trend would continue for rest of the year.
Right. And what about specialized staffing? I mean, the growth out there has slowed down, right? What's the outlook there?
Yes, specialized staffing will be flattish for rest of the year, and especially because of the IT segment, as I mentioned earlier. However, in general staffing, we are forecasting almost close to a 30% growth year on year in gross revenues. And in terms of headcount, again, upwards of 20% is what we are forecasting. Also, across all of our businesses, now all the investments have been fully absorbed. We are not going to add any further costs for the next few quarters. So we have a clear pipeline in terms of margin expansion and profit expansion for the next few quarters as well.
Okay, so when you're talking about margin expansion, no costs being incurred, no additional costs coming in other quarters, what is the outlook on margin recovery? In quarter 2 of FY22, you were at 2.24%. It has fallen to 1.62% in the quarter gone by. Will it consecutively improve? What is the outlook here?
Yeah. So we are focusing a lot on absolute profit improvement because in terms of margins, so we are constrained by the inflation in our associate salaries because, again, over the last 2 years, so if you look at the salary inflations, they're almost 3 times higher than what it used to be pre-COVID levels. So we used to have about 4-5% of annual inflation in our associate salaries. That number is currently at about 11 to 12%. So that has led to a substantial dilution in our margins. However, having said that, now with the kind of inflation, salary inflation levels being kind of stabilizing, and our internal costs are also being fully absorbed with no incremental investments coming into place. So we are confident of expanding the margins consistently quarter on quarter from here onwards.
Ramani, the net hiring has come in at about 4,700, which is similar to where you were before COVID. Would revenue growth also converge to pre-COVID kind of levels? Could you provide us with some guidance?
It would be higher than pre-COVID levels because whatever interventions that we have made in our clients' approach, vertical-wise, industry-wise approach, so that has started giving us higher pipeline and higher hiring volumes. So in H1, between Q1 and Q2, both put together, we did close to about 18,000 headcount addition in our general staffing. Q2 is slightly lower, but however, on a H1 basis, we did about 18,000 odd, and we'll be doing around same number, similar number for H2 as well. So on a full year basis, we will maintain a revenue growth of close to 30% and headcount growth, year-on-year headcount growth of close to 20-21%.
All right, 20-21% is the headcount growth and 30% is the revenue growth. Take that point, Ramani. Thank you so much for joining in, giving us the outlook. With that, we take a short break. On the other side, we discuss market technicals with Jay Thakkar. Less than 200 points away from a fresh record high on the Nifty, just about 191 as we speak, inching closer to a fresh record high for that index. And as we do that, let's take a look at what the F&O space is looking like at midday. The party is moved definitely to the 18,400 mark because of the last couple of trading sessions, 18,300 puts and calls were extremely active. Now look at 18,400 put, 56 lakh shares added in open interest for a premium of 50 rupees. So the street believes that 18,350 could be an important support to watch out for. And 18,350 put writers extremely active as well, 30 lakh shares written out there for about 35 rupees of premium as well. But bears still don't want to give up the fight. They're saying 18,400 call is something that is their terrain. We have seen, action moving to the 18,400 straddle. If you just take a look at the premium between 18,400 call as well as the put, it's almost 125 rupees. This is for options that expire tomorrow. So the Nifty support for those straddle writers has moved higher between 18,275 to around 18,300. This is higher from levels of 18,150 to 18,200 that we saw earlier. And it's important to track levels upwards of 18,500. If the market sustains above that, these call writers will have to cover their positions just the way they did yesterday as well. And if it doesn't, then maybe, we are looking at a fight for the 18,400 mark in tomorrow's expiry itself. So that's about the F&O setup. So let's get in a technical view on the market as well. Jay Thakkar joins in. Jay, less than 200 points away from a fresh all-time high. But every time we reach a mark near 100, say 18,300 or 18,400, there is a bit of a tug-of-war. And you're wearing a red shirt. What's happening?
That's a contra, I would say, sign. So if I have won a very good afternoon to you, first of all, Mangalam, but then that's not actually pointing out my, view on the market. My view is positive, at least for the short term, Mangalam. And I believe that, yes, as you rightly pointed out, 18,300 now, from the at least weekly expiry point of view, that's tomorrow. I believe that that will act as a very crucial support in the short term. And until those levels are held, the possibility of an all-time high, maybe tomorrow, maybe the week, in the coming week, is quite high. I mean, we have already seen a lifetime high coming on Bank Nifty, and the momentum out there has been quite positive. I mean, if you compare Bank Nifty option with that of Nifty's, and we have been seeing that good amount of aggressive put writing happening right from 42,400 until 42,000 levels, and I believe that 42,500 levels should be taken off today convincingly on a closing basis. And that momentum in the Bank Nifty also eventually will help Nifty to move higher. And we have been seeing that Nifty IT is also performing quite well. So my targets are all-time high for Nifty, 18,600, 18,700 range on the upside. One can place a stop loss on a closing basis below 18,300 on Nifty. Bank Nifty, 42,000. That's the support. Positional perspective, and I believe that 42,850 immediately, and thereafter 43,000 plus levels can be seen out there. I have two buy recommendations as well, Mangalam, as far as stocks are concerned. The first buy recommendation is from the banking pack, that too from the private sector bank, and that's on Kotak Bank, wherein we have seen a fresh breakout coming in today's trading session. There's a nice inverse head and shoulders pattern that's been formed as well, and I think the breakout will be seen about the levels of 2,000 levels. The short-term targets out there would be 2,030 and 2,060. One can place the stop loss below the levels of 1920. The second buy recommendation, Mangalam, out here would be on UBL. Now, we have been seeing that UBL has been consolidating now since a couple of trading weeks. I think this consolidation is likely to provide a breakout on the upside since the momentum has turned positive. one can buy UBL, placing a stop loss below 1650, that is 1650, and the targets on the upside, the breakout targets on the upside will be 1775 to 1810.
Okay, all right, Jay, thanks a lot for joining us and taking us through your individual technical picks and levels to watch for in the Nifty, on the Nifty and the other index as well. With that, we'll slip into a short break. We'll get you more on markets and stock-specific action on the other side of this very short break. Stay tuned.
Countdown to the world's most prestigious accountancy professional event has begun. The 21st World Congress of Accountants is being organized from 18th to 21st November 2022 at Geo World Center, Mumbai, hosted by one of the largest accountancy bodies in the world, the Institute of Chartered Accountants of India. For the first time in 118 years, over 150 speakers, more than 6,000 delegates from over 100 countries on a single platform. Witness this mega conference. For details, visit icai.org.
आज ध्रुव के स्कूल से फोन आया, कहने लगे कि फीस भरो वरना कल से स्कूल आना बंद। क्या कहती हूँ कि बाप की गैर जिम्मेदारी की सजा बेटे को मत दो। तुम तो टर्म लाइफ इंश्योरेंस लिए बिना ही चले गए।
Policybazaar.com पे 1 करोड़ का टर्म लाइफ इंश्योरेंस सिर्फ 430 रुपए महीने से शुरू।
Will snow days be a thing of the past? Or are we smarter than that?
Presenting the next challenge between two animals.
Who seems faster amongst the two? Then why place all your bets on the elephant? Similarly, in investments, horses are like smaller companies. Even with ups and downs in the journey, they can run faster than the elephant like big companies and show higher potential. Along with investing in the horse, what if you also get tax savings? That's right. Introducing Samco ELSS Tax Saver Fund that aims to create wealth for you by investing in high-quality small and mid-sized Indian companies and also helps you save tax with ELSS. Invest today. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Okay, welcome back. There was 20 points now on the Nifty. So let's see if this one holds. We got a pop, about half an hour, 40 minutes back, which did not last. So this is the latest one. Let's put up Campus Activewear. It's seeing a recovery. I mean, it's up 5.5% today after falling. The recent high was 650 rupees 15 days back. And from there, it fell all the way to about 400. And today, it's recouping some of the lost ground, basically making up for what it lost yesterday. Still a far cry from the recent high. All right, let's get you some updates on stock-specific action now. MSCI updates on the treatment of L&T Infotech, LTI, and Mindtree stocks post their merger. Vivek is here with the details on how this will work. Vivek, over to you.
Well, that's right. So, one aspect that was pending in terms of, how exactly would the passive or the index manager would actually manage and handle the merger of LTI and Mindtree, that has now been cleared yesterday. So, this does have ramifications even in the passive fund management as well. So, what's actually happened is that MSCI has now said that after Larsen & Toubro, Infotech and Mindtree have announced the merger date, record date as 24th of November, what they will do is on 22nd of November, they will now be removing Mindtree from the MSCI standard index, and they will be increasing the weight of Larsen & Toubro Infotech in that particular day itself, in that particular session itself. So it's a largely net neutral event. Mindtree, will be deleted from the MSCI indices, and LTI will actually see a weight increase. So it'll be interesting to see on 22nd, how this particular move impacts both the stocks. But that would basically largely cover cover the impact of the merger on how passive funds will actually be handling this particular development.
Okay, all right. Vivek, thank you so much for joining us with all those details. The other stock on our radar is TCNS Clothing, surging in trade after reports suggest that multiple companies are looking at the promoter stake. Mangalam, what are you picking up?
Well, it's not me picking up. It's news reports coming by. And it's interesting because, a lot of people go to buy clothes at TCNS, and here there are a lot of companies who are looking to buy TCNS itself, and that's the promoter stake that we're talking about. Live Mint this morning had reported that we have a lot of suitors for this company, and they range from people like Reliance Retail, there is Nykaa, Aditya Birla Fashion and Retail, Trent, all of them looking to buy, the promoter's stake, TA Associates, which is a PE firm, which holds about 29% stake in the company. These are the ones who are interested in buying. And not just these corporates, we have a lot of institutional interests coming in as well. PE funds like TPG as well as Advent are the other suitors for this as well, as a result of which we've seen some action in the stock in today's trading session. But not just today. CNBC-TV18 told you in August itself, Nisha had said that, the promoter's stake has, has been on the block way back in August. So this seems like a bit of a follow-up on that story itself, as a result of which there is some action there.
Okay, all right. So that is about TCNS Clothing. The stock is up 8.5% in trade today, but the stock which is under some pressure today is Apollo Tyres. Sonia, what are the brokerages saying, and some conference call takeaways as well here?
Well, thanks a lot for that. So, brokerages are largely bullish on Apollo Tyres despite the fall that we've seen today. Citi has a buy call, raised their target price to 340. Morgan Stanley has an overweight call and raised their target price to 329. Nomura has downgraded the stock but is still at a neutral with a target price of 327. Now, most brokerages are bullish because the company has been giving very strong guidance. They say that there will be a 20% growth in the domestic business going forward in the standalone entity because of the good pickup that they've seen in the commercial vehicle replacement demand, as well as a sustained growth from the OEM replacement demand overall. Not just that, to compensate for the higher prices, they have higher raw material prices. They've gone ahead and taken price hikes of about 5% in the replacement segment in India, and 5 to 12% price hike is what they've taken in the Europe region, which is important because it has been a challenging environment there. Despite that, they've recorded an EBITDA growth sequentially in their European business. However, the problem really for Apollo Tyres, and I reckon that's the reason why the stock is under pressure, is that debt has been rising. The consolidated net debt for Apollo Tyres has risen to 5,500 crores in Q2 compared to 4,700 crores at the end of FY22, and that seems to be the reason that the stock is seeing some profit taking today. Back to you.
All right. Okay, Sonia, thank you so much for all those details. Apollo Tyres down around 5%. We'll do one thing. We'll slip into a break now. On the other side, we'll focus on the two new listings on the exchanges, Bikaji Foods and Global Health.
Well, it's been a steady listing today for Bikaji Foods and Global Health, Indian ethnic snacks maker. Bikaji actually listed about at a 10% premium on debut. In fact, if you just take a look at the way the stock has performed in today's trading session, opened about 7% higher, saw some purchase at around the 330 mark is where the stock is settled. Why is that? Well, because one, is the third largest ethnic snacks maker in the country, has about 4 factories in Bikaner, 1 in Guwahati. FY22 revenues were close to around 1,600 crores with 7% margins. This morning we spoke with the management and they said that in the second half of this year, they expect margins to be in the double-digit region with revenues crossing that 2,000 crore mark. In fact, why is this year? Going forward as well, given the sort of capacity that they have, they can continue to grow, maintain their growth rate between 20 to 25%, and they don't need capex until 4,000 crores of revenue, which they believe will come between FY26 and FY25 itself. For FY24, they believe that the net profit of the company could be anywhere between 120 to 130 crores, given that they will do around 2,500 crores in revenue. 10% EBITDA margins would give them around 250 crores in EBITDA. And with that, it means that the stock at current levels trades at around 63, 64 times FY24 price to earnings. Not particularly cheap, and there are a fair amount of risks as well. The biggest one being competition coming in from strong local brands as well as MNCs. Rajasthan, Assam and Bihar accounting for 75% of their sales. They are looking to move out of these markets as well, go into focus markets where if they are spending a lot more, perhaps that may be margin dilutive, but they may see some more competition. And finally, raw material inflation. We're not yet done with that. So that could impact margins going forward as well. So let's get an insight into what the management said to us this morning, after which we saw that smidge of an uptick on the stock. This is Insight Edge.
Last 3-4 years we're growing at 22% CAGR, and it's a big industry. So this industry is close to 1.5 lakh crore of markets, and we are just a 600 crore rupees. We've done and it's a strong growth prospect which we looks in the coming decade, and it's a big industry, and we being done expansion across all part of India. So basically 240-250 crore of EBITDA will have close, 240-250 crore EBITDA will have close to 130-140 crore of PAT, because depreciation close to 40-45 crore. That's it. Currently, our core market is giving close to 72% of our business, and the focus market are giving close to 17-18% of our business. So yeah, of course, focus is always growing at 1.5 to 2 times of core market. So in next 3-4 years, it will this 17-18% will target to grow this to 20-23%.
Okay, that is about Bikaji Foods, but the other stock that opened with a bang today is Medanta, operator Global Health, listed on the exchanges. It saw a 19% premium over its issue price, and now it has actually gained further. So it's a 25% gain at 420 rupees a share. If we look at the valuations after this particular listing, earlier it was trading at a discount with its against its peers, something like an Apollo Hospital, HCG, Fortis Health. After this, it is trading around 22 times FY22 EV to EBITDA. So it is slightly more expensive than HCG and Fortis Health, but still lower than Max Health. So valuations was one of the key points why this particular stock was favored against the other hospitals, and the subscription figure was really strong as well. So 10 times was the overall subscription that this particular IPO saw. In terms of financials, yes, strong fundamentals here. Revenue growth of 27% in Q1, margins at 21.4%, which compares with 20.6% that the company saw in FY22, and profits also grew 41%. So looks good as far as financials of the company are concerned. About the company, as we know, cardiac surgeon Dr. Naresh Trehan promoted the chain of hospitals here, and it operates network of 5 hospitals under the brand Medanta, total of 2,467 beds right now. They expect it to scale up to 3,500 beds by FY25, and they're adding on more hospitals as well. In fact, we spoke to the management earlier today. Let's listen into what they had to say.
We are currently at approximately 2,500 beds across the network, across the 5 hospitals that I mentioned. That's in Gurgaon, in Lucknow, in Patna, Ranchi and Indore. And these beds will scale up to about 3,500 by financial year 25. The bulk of that incremental capacity will come in Lucknow, which is currently operating at about 500 beds, and that will scale up to about 1,000 beds, 950 to 1,000 beds.
All right, with that, we'll take a short break on this edition of Halftime Report. On the other side, we get Manisha speaking all things commodities.
Choose a better route and aim to stay ahead with HDFC Business Cycle Fund. NFO closes 25th November 2022. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
आग को फैलने से रोकना मुश्किल है, पर नामुमकिन नहीं। अब फायरवॉल टेक्नोलॉजी के साथ सेंचुरी प्लाई क्लब प्राइम आग से बचाए।
To make my vision a reality, I have to see clearly from every point of view. With my Verilux progressive lenses, I seamlessly transition from near to far and see every detail in sharp focus. When you see no limits, there are no limits. Verilux lenses by Essilor.
Odisha, the unstoppable force, welcomes you to highlight Odisha's emerging industrial aptitude. Our visionary leadership introduced an inspired idea, the Make in Odisha Conclave. Odisha is ready to enthrall you all over again. Align with the growth ideas from thought leaders, finding ways to explore the zenith and beyond, showcasing skills, encouraging startups, enhancing women-led entrepreneurship, developing our designated key focus sectors, celebrating culture like never before. We are ready for us.
I invite you all to the Make in Odisha Conclave. Come join the juggernaut.
Do we have to wait years for a cure?
Hey, Mommy, can we go make some pancakes?
Yeah, let's go. Or are we smarter than that?
Welcome back, and gold is clearly the flavor of the season. We have seen good buying coming in from the Indian markets here, and the prices have been on the uptrend as well, trading at a 3-month highs. 53,000 has been taken up in case of the Indian markets here. Joining us then to talk about that is Gaurav Mathur. He is MD Safe Gold, and he joins us on the show. Gaurav, hi, good to have you. And this quarter really decides on what kind of sales would we have in the overall year. And while the physical buying, the wedding jewelry buying is absolutely on, but the digital gold investment also seems to be picking up quite strongly.
Hi, Manisha. Thanks so much for having me. You're absolutely right. I think the overall market is doing quite well, and sort of offline and digital both are doing well. Digital, obviously, had a great run when there was COVID and people had no other options. So I think the growth rate has continued at maybe 40-50% for the digital market, and offline has, I think, bounced back a lot stronger this year. So in terms of growth rates, probably offline maybe a little bit higher this year.
What is the kind of participation that you have seen on your platform, Gaurav, and what has been the kind of demand growth there?
So participation, if you look at our platform, we do about 7 to 8 million transactions in a month. If you look at the same period last year, we did about 4.5-5 million transactions in a month. So that's a rough sense of the growth that we've had in terms of number of transactions. And the ticket size for digital gold has stayed about flat between last year and this year. It's about 1,200, 1,300 rupees per transaction.
All right. Gaurav, you've also come up with leasing of gold. How many, it's still early days clearly, but what is the kind of feedback, participation, enthusiasm that you've seen among your users?
So I think the feedback enthusiasm has been outstanding. So we have metal leasing, and whatever we list on our website gets sold out within 1 or 2 hours. These are specific leases from jewelers that we list, and there is massive enthusiasm for customers to lease out their gold and earn a yield on an asset that's otherwise idle. So it's about a month old, so the absolute numbers are still not very big. But there is massive enthusiasm. We have a huge waiting list of maybe 30 or 40,000 people waiting to lease out their gold. We are obviously taking it a little slow in terms of bringing the jewelers on board, because we're doing a lot of diligence, making sure that only fairly high quality names with high quality collateral come on board. But looking forward, we think this is something that could easily be 10, 15, 20 tons a year that we could be leasing out.
So Gaurav, if I've bought digital gold of, let's say, 5 grams or 10 grams is what I'm holding on my wallet or app or account, let's say, of course, as and when the gold prices go higher, that's my earning clearly. But if I'm leasing it out, what extra do I earn on this gold?
So on average, the lease you can get is 3 or 4%, which means that if you have 100 grams at the start of the year and you lease it out, you'll have 103 or 104 grams in your account at the end of the year. So the lease rentals are actually paid in grams of gold. So the grams of gold that you have actually increase with your lease rentals.
Oh, that's amazing. Also, I mean, you've told us about the kind of participation and transactions that we've seen. What has been the growth really when you look at the new users coming in for this? And would you have geographies in hand as well? Where do you have more participation from?
Geographically, I think we're pretty broad-based. So we don't have, super accurate data geographically, but it mirrors broader gold consumption in the country, where say 40% is in the south, and east maybe a little bit lower, but the rest is in the north and the west. In terms of growth rates of participation, as I said, if we do about, we track transactions, let's say 8-9 million transactions in a month, on average, a user will do maybe 1.2, 1.5 transactions. So that would be, so if you translate that back into number of users, we'd have maybe 5 million unique users sort of in a month. And the growth in number of users and participation has sort of broadly reflected the growth in our transactions. So the number of users and the number of transactions per users has remained more or less constant over the last 1 or 2 years.
Gaurav, the only concern that perhaps digital gold has is that it's not regulated, but a lot of jewelers have associated with you. How is that working for you? How are you making consumers aware of that? How are you allaying their fears, basically?
So I think 2 parts to that. One is we're, of course, I'd say our aim is to be a regulated entity. We've been applying to various sandboxes. We've been engaging with various regulators and, submitting our thoughts in terms of, what kind of framework contribute to regulate digital gold. So in the long term, or I'd say in the medium term, our goal is to be a regulated entity. And we would like to engage in any way, shape, or form that we can with the regulators to make sure that we run like a regulated business. That being said, our operations have been structured to mirror what a regulated entity does. We have an independent trustee that is responsible for safeguarding customer interests. So we don't get any money directly when we sell gold. It goes to an account controlled by a trustee administrator. When they verify that we have that much gold in the vault representing consumer purchase, then the money gets released to us. And if anything were to happen to us, not that we expect it to happen, but in the unlikely event, then the trustee administrator has a copy of everyone's KYC. They can, step in, distribute assets in the vault, which are owned by the customer. They will distribute them to the customers. And given all the talk about crypto and what's happened with new age technology assets, I think this structure that we set up, where we've copied how regulated entities are structured, where client assets are always segregated, always safe, protected by an independent custodian, independent trustee. We've tried to put every check and balance in place that we can think of that would make sure that customer assets are protected.
Okay. That is assuring. One final question. So, even when you look at India, even now, 80 to 85% of our buying basically is in the physical markets. Bridal jewelry is a big part of this, especially with the gold prices now rising. What kind of a participation are you seeing? And within the investment market, how are you looking at the growth? So,
I think long term, 70-80% of our buying will always be physical because that is jewelry. It's the 100 to 200 tons a year that we buy in coins and bars, which is investment demand, and maybe there's another 10-20 tons, which is between sovereign gold bonds and ETFs and digital gold and things like that. So I'd say long term, especially once we can popularize things like gains, which is a leasing product, and people can start earning a yield on it, then we expect a large share of the investment demand to fit to products and formats where customers earn a lease. But the jewelry demand will stay offline. We don't see that jewelry demand coming online. That's a different market. That's consumer durable business.
Okay, Mr. Mathur, thank you so much for that. Manisha, thank you so much for taking us through that sparkling discussion. Of course, jewelry demand, where is it going, right? That continues to remain only increasing, of course. So thank you so much for that discussion. And with that, we'll wrap on this show. And as we do that, we leave you with some market opinion coming in from Jonathan Garner of Morgan Stanley and CLSA's Lawrence Blanco. Listen in.
A new upcycle in semiconductors and technology hardware is poised to begin, and that's why we upgraded Korea and Taiwan within Asia and EM at the start of October. And I'm pleased to say both those markets are already performing very strongly in the last few weeks, which is highly indicative that the overall EM asset class has reached a trough. India is by far the most expensive market in our coverage, in fact at a record high valuation premium, for example, to Korea, but certainly the valuations are very rich to history and to peers, and that's why it is an underweight for us.
We saw sentiment extremes into the October lows, as well as a number of market divergences that has led to the current rally that we've seen play out across global markets. And our work that we've done on our cycles into 2023 does suggest that we do overshoot the upside, and we think the S&P can trade above its 200-day moving average. And the Nifty on the back of that should trade to new all-time highs, and we get an upside target closer to the 20,100 area for the Nifty into the first quarter of next year. If we look at the Indian markets through the first half of this year, we found that support around the 15,500 area, and we do think that's shifted up towards the 17,000 to 16,900 area. So that should be a sort of a key floor heading into the first quarter.